Don't we rumble, float like a butterfly, and sting like a bee. Ah, rumble, young man, rumble. Down goes Frazier! Down goes Frazier!
It's time to get in the ring with the Cornerman, preparing dentists for the next round. We give you business insights, trends, and timely information. And we'll interview experts to help you make smart financial decisions. Now, here are your Cornermen, Rob Joyce and Mike Bark.
Welcome back to the Cornerman Podcast. This is Mike Bark. I'm again joined by Megan Rutkowski, one of our partners here at Bull Moose. And today we're kind of going over the tax tricks and treats that are out there in the tax code as we're recording this on October 30th. And what we want to do is kind of go over some tax planning, some tips here as we go into the end of the year, as we roll into the fourth quarter of things you should be thinking about and things you might want to consider doing if you haven't done them in the past. And just kind of give people a good overview of the tax code, what's deductible, what's not deductible, and some things they can do. And I think the first place we want to kind of start is just with an overview of the tax code, especially as it pertains to our clients. I think most people will complain about the level of taxation that they have to pay. And I think they have to realize a few things. The first one is we tax income and not wealth in this country. So people who are actually out there, they're making money, they're in a professional service or whatnot. You have a high income, we have an income tax, we don't really have a wealth tax. So you end up paying a lot of taxes if you're making a lot of money. The second thing is if you're at a party and you're talking to your buddy who might be in the construction company, I think you have to realize that there's some biases in the tax code to encourage certain industries and not necessarily discourage you being in a professional service as a doctor, dentist, accountant, financial advisor, or whatnot. But there are some biases in the law, and a couple examples of that would be the qualified business income tax deduction that's out there that basically says a business can deduct up to 20% of its profits in any year. If I'm a construction company or a manufacturer, or a farmer, or any other type of business, that 20% is on the entirety of my taxable income. Whereas as a professional service provider, that deduction starts to get phased out the minute I start making more than $315,000 as a married couple, and that includes my spouse's income as part of that calculation. Other things that are out there, if I'm a realist or a manufacturer or a construction company, I can use things like percentage of completion or inventory, some numbers that maybe have a little bit of manipulation in them to either drive up or drive down my profit depending on what the year is. In a service company, we collect our bills as we invoice them. We have expenses as we pay them. There's not as much we can do to manipulate our income. And then I think a big thing, again, if you're talking to other businesses, there could be businesses who do conceal things like cash and things like that to drive down their income. We don't have that. People pay with checks. People pay in our healthcare providers with insurance. Most of our income is subject to 1099. So the IRS knows exactly how much money we're bringing into the thing before we even start to do our tax return. So those are some just things as overview. I know nobody likes paying tax, Megan, but there's just some hurdles that we have to cross. So a few things that we want to go over just in terms of how you can best minimize your taxes and pay as little tax as humanly possible on this is, first thing is the choice of entity that you are. And most of our clients have this knee-jerk reaction that they have to be an S corporation right away because they were at a study club or they were talking to an older dentist and that person said, well, we're an S corporation and here's why. And that's all fine, well, and good, except the law changed 2 years ago. And the biggest change in the law is the 20% qualified business deduction. So if you're in a business where you are going to make less than $315,000 in a year, you are probably better off being an LLC versus a subchapter S corporation, because that 20% income tax deduction will outweigh some of the tax benefits that an S corporation has. The biggest tax benefit that an S corporation will have is you can split your income into two different chunks as a business owner. The first would be W-2 compensation that you're taking as reasonable compensation for the services that you're offering. And that income is subject to income tax, it's subject to FICA and Medicare tax. The second chunk of income you get is the profits of the company, which are no longer subject to FICA and Medicare tax. So on a highly profitable business, that's a service company, we can usually save somewhere between $5,000 to upwards of $15,000 a year by being an S corporation versus an LLC. However, if you are under that $315,000 threshold, you may be better off being an LLC. A couple other things when people do make that choice of entity, they have to consider is, are they going to have losses early on in the business? The deductibility of losses is far different in an S corporation than it is in an LLC, and it's harder to get accomplished. You have to consider how much money are you going to need to take out of the business, because if you distribute too much money from an S corporation, you create negative basis, you have a capital gains tax, and that's something that you don't necessarily have to worry about as an LLC. So now more than ever, it's important for people, if they're starting a business, to take the right entity, because if they don't, I think it's a matter of they could pay $5,000, $10,000, $15,000, $20,000 more in taxes just simply because they're not filing the right tax form. So I think that's one big thing to keep in mind when you're starting up the business. Then Megan's going to go into some of the other aspects that we're looking at when we start to put together a tax projection, like tax brackets, depreciation, and cost segregations.
Mike, first I wanted to say with the S Corp, a couple things to keep in mind. One, when you make that election to get out of it, you can't be an S Corp again for 5 years, correct? And then the other thing with the qualified business income deduction, that's scheduled to go away in 2025, absent any tax law changes. So it always is worth talking to your tax advisor to find out where things are, what the current environment is.
And that's a really good point, because some of our existing clients have asked, well, I'm under that $315,000 threshold. Why wouldn't I convert from the S corporation that I was several years ago now to an LLC? And again, you have to stay with that election for 5 years once you decide you're not going to take it anymore, and tax law could change next year. So that's something, a really good point to keep in mind.
And you don't have to make the S Corp decision immediately. I mean, the elections needs to be made by March 15th of the taxable year, but there's late election provisions that give you up to 3 years to make it, as long as you're acting like one. So that shouldn't be the deciding factor, getting the election in by March 15th. Okay, talking about tax brackets a little bit, I think most people have a general idea that we have a graduated tax system in the US. So there's brackets. Our lowest bracket's 10%. I pulled the 2021 brackets, which were just published, I think, in the past couple of days. So for a married filing joint couple, your first $19,900 of income is taxed at 10%. And then up to $81,000 is 12%. Up to $172,000 is 22%. 329, you get up to 24%, and then 32, 35, 37. So the top bracket you hit at $628,000 of married filing joint income. And for a single taxpayer, you hit the top bracket at $523,000. So there's a couple of things you can do that will totally lower your taxable income in 1 year. Like usually with the service industry, depreciation can be a pretty big deduction. What you want to watch out for is that you're not dropping yourself into a 10% bracket in 1 year only to be a 37% bracket the next year. So the timing of some of the deductions, I think, is important. So speaking of depreciation, there is 3 basic write-off provisions, and I'm sure you've all heard of these before too. So the 179 expense deduction has been around for a long time, and that's an immediate write-off, and it started wasn't it 25,000
Mhm.
maybe 20 years ago? So you're
I remember when it was 17.5.
okay.
So I'm that old.
17.5, but it's the past maybe 10 years, it's gone up. It was at 250, 500,000. Now it's 1,040,000 because it's inflation adjusted. So in the dental industry, you're not probably going to get up to $1 million piece of equipment. In manufacturing, they do all the time. And then there's phase outs based on how much investment in equipment you have too. We won't get into all of that. So if you buy a new machine and it's $80,000, you can likely write it off under Section 179 in year one. You may not want to do that because you might want some of that deduction in the next year. So depreciation on equipment would be over 5 years. And it's not exactly straight line. It's 20% the first year, I think 32% the second year, if you don't take the 179 expense deduction. You can also choose to only take like half of it. You could say, I'm going to write off 40,000 of this $80,000 piece of equipment in year one, and then depreciate the rest over 5 years. The one caveat with 179 is you can't put your income below zero with it. So you can only write off to get your taxable income to zero, which, as we sort of mentioned, probably is a bad idea. You want to save some of those deductions when you're in higher tax brackets. And then recently, in the past couple of years, they've added that you can include, because this used to be just tangible property, but now you can include qualified improvement property, which would fall under roofs, HVAC, fire protection, security. You can write off, I think it's up to 250,000. I don't know if that limit went away or not. So there's a lot of flexibility to write off a lot of things that you're doing. The second accelerated depreciation is called bonus depreciation, or sometimes called special depreciation. And this too started at 30%. And I don't know, Mike, if you remember the year where it changed on May 5th or something, there was,
it was
like a day where we had to track it separately, differently through the year. But now it's moved up to 100%. And it's going to phase back down 80, 60, I think, in the next couple of years. But in 2021, it's still 100% bonus depreciation. So it's very similar to 179. You can write off the whole amount. It's automatic, but you can elect not to use it if you don't want to write off a huge piece of equipment in year one. And then you can also bring your income below zero with bonus depreciation, which for manufacturers, I mean, they can write off a lot. And then the last way is the de minimis rule, which is a lot smaller, but for record keeping, it makes it easier. So you can deduct up to $2,500 per item or per invoice in the year of something purchased. So you buy a new computer and it's $1,500. Instead of depreciating that over 5 years or even messing around putting it on the schedule, you just can expense it immediately. If you buy 10 computers for $1,500, that's over $2,500, but it's a per item rule as well. So you'd write off all of those computers. And then the last thing I just want to mention is not all states are the same on depreciation. So for example, in Wisconsin, we are the same as federal with 179. Whatever you do for federal works for Wisconsin, but Wisconsin does not allow bonus depreciation. So there may be add backs on your state returns related to depreciation, but then in future years, you'd have more state depreciation to catch it up. So over time, you're depreciating the same for federal and state. It just may be in different years.
I think when we take over clients, I mean, one of the biggest tax mistakes we end up seeing, on somebody who might be in year 3 or year 4 of ownership is they acquire their dental practice and they have a loan in order to buy that practice. And in year 1, they section 179 all the assets they have or take bonus depreciation on everything. And the problem there is, they end up having 1 year where they pay little to no income tax. But now as that practice starts at some level of maturity in year 2, 3, and 4, there's no deduction to offset some higher income they have, but they're still paying off the bank loan at that point. So they're kind of creating this phantom income thing. So when you're looking at Section 179 or bonus depreciation, and we're putting together projections, one of the things we're trying to ask you or get a feel for is, what is your plan in the next 2, 3, 4 years to see, are you going to be buying a lot more equipment? Will you be relocating sometime soon? And that's going to help inform our decision as to how much of that Section 179 or bonus depreciation we want to take.
One of the other items that you can consider if you own your building or even do a remodeling project is a cost segregation study. And I know this is out there in some of the podcasts, so I know a lot of you have heard about it. And what this is it's a study done not by CPAs, but by people with an engineering background. A lot of times they work at CPA firms, but sometimes they're boutique firms as well. But what that does is, so say you own a $500,000 building and maybe 150 is allocated to land and the rest is allocated to building. Normally that would be depreciated over 39 years for commercial property. With a cost seg study, they go in and they look at the property, they look at the blueprints, they actually go on site and they can break out things with shorter lives like built-in cabinetry. And then even the dedicated electrical to some of the equipment has a shorter life. It can be depreciated over 5 years. They'll look at your land improvements, driveway, sidewalk, that can be depreciated over 15 years. And then the big bonus with this, if you're really looking for a big write-off, is anything that's a shorter lived asset. So the 5-year cabinetry, equipment, electrical, and then the 15-year land improvements, you probably can write those off 100% in the year the study's done if you want to. So this doesn't need to be done when the building's purchased or when the remodeling project is done, completed. Depreciation, since its timing, can be done at any point that you still have basis in the building. And then we can add it to the return. There's a 3115 form that you put it in if it's in a subsequent year. It became really popular this year because they changed. There was finally a technical correction on the qualified improvement property, which was classified as 39-year. Congress changed it with some of the Coronavirus Stimulus Act to make it a 15-year property. So now it's eligible for bonus depreciation. So those can be, if you're owning a building, that can give you a pretty substantial deduction. And because of the self-rental rule, if the building is used in your practice, which is an active business for you, you can use those, any losses generated there, against your practice income.
And I think, again, a big thing to remember on these is they can be done retroactively. So cost segregation studies have been popular, I would say, for the last maybe 5 to 7 years, where the law really started to have some clarity as to what the procedures were and what you could do and what you couldn't do. So if you're in year 10 of owning your building and you've never had one done, there's a computation that's done and you can do all of the catch up that you would have gotten and take that all within 1 year. So it can be a massive tax deduction, especially for somebody who owns their own building. So if you haven't had one done, what most companies will do, we use actually one of our competitors to do a lot of them, Baker Tilly. They'll do a feasibility study first at no charge to you to make sure it makes sense. And if it does, in most cases, those cost segregation studies are done between, I would say, $3,000 to $5,000 to get one done. And the ones that are more expensive would have that change of accounting method form in there, that 3115, which is a relatively complicated form to pull together and do and change that depreciation method. But it's one of those things that's a very lucrative deduction. And with most commercial real estate being 39 years, I'm kind of hoping we're not all doing this in 39 years to capture all the depreciation. So if we can speed it up, all the better.
I had a client doing this year, not a dental client, a real estate investor. So the situation's a little different, but they came up with another $300,000 of deductions for him this year. And then I did have another client too, who was behind on taxes, and we did the cost seg study, which really helped the balance due that he owed the IRS. So it was a great situation in that case.
So let's go on to some of the deductions that are relatively commonplace that in reviewing tax returns when we take over clients are sometimes missed or not maybe utilized as efficiently as they could. And I think one of the basic things just to understand right at the beginning is there's two things in the tax law that kind of override everything else. One is that a deduction has to be ordinary and necessary for your business. So deductions aren't all created equal for every business across the way. Things that might be ordinary and necessary for a chemical engineering plant may be completely different than a dental office or a construction company. The second is a concept called substance over form, meaning we can cross all the technical jargon in terms of a law, but if your overall purpose is tax avoidance, they can overturn that particular deduction. So those are two things to kind of keep in mind whenever somebody talks to us about tax deductions or maybe things they heard. I think as CPAs, our job is to tell you, well, if you get audited, here's potentially what could happen with that, and here's how it needs to be documented to make it a legitimate deduction. So the first one, and I'm always surprised when we don't see at least some vehicle expense on a tax return, but I believe every tax return should have some type of automobile or vehicle expense on it. And you have a couple different ways that you can write off your vehicle expense. The most common decision somebody has to make is between mileage and actual costs of a vehicle. Most of the times, and especially a few years ago before the tax law changed a little bit, most of our clients would use a mileage reimbursement for their travel. Big thing on the mileage is you do have to understand your first commute is not a tax deductible event. So driving into your office is on you at the end of the day. However, every time you drive to a Costco, you drive to continuing education, you drive to meet with your accountant or your attorney, or you go to a study club, all that is deductible mileage. And we'll typically set our clients up on some type of monthly allowance based on their facts and circumstances and try to true that up at the end of the year. The big change in the law 2 years ago was to make the depreciation rules slightly more favorable for the ownership of a vehicle. In the old days, or 3 years ago, which seems like it may have been 30 years ago given this year, there were pretty severe limitations on the depreciation of a vehicle that weighed under 6,000 pounds. There were what they would call luxury automobile limits to it. And that kind of made going and buying a vehicle maybe a harder stretch, because if you buy the vehicle, now you have to use actual expenses of it. And because you really couldn't depreciate that vehicle all that quickly, it kind of made it a losing proposition over mileage. Big difference now is if you buy a large vehicle, you can write off using Section 179 the first $25,000 of that vehicle. And then Megan, correct me if I'm wrong, but then you can use bonus depreciation or write off the remaining balance if you wanted to. But
that's got to be over 6,000 pounds.
Over a 6,000 pound vehicle. When we're talking our smaller vehicles, depreciation is going to be limited still, but much more favorable than it's been in the past, where you can do the first about $18,000 of the cost, the way the math works out, and then have the rest depreciated over the next 5 years.
Yeah, I think it's 18,100 the first year, 16,100, 9,700 the third year.
So with a smaller vehicle, you'll be able to recoup that cost a lot more quickly than you could in the past. The basic rule for owning a vehicle within your business and having it be a tax deduction is it has to be used for more than 50% of business use. And in some respects, that could be a hard hurdle for a single office dentist or doctor to be able to clear, because again, that commute's not going to be deductible. We'll talk about one of the deductions that helps work around that coming up here with home office, but it should be something that's used at least 50% for your business. We should always be adding back some element of personal use of the automobile onto either your W-2 or onto your tax return at the end of the year, because of all those miles that you're going, some of it is going to be personal use. I don't see a way you could sit there and look at an auditor with a straight face and go, no, I only use this particular vehicle for business. I mean, maybe if you're a car collector and you have 6 or 7 cars, you can make that argument, but this is one of those deductions where if you do get audited, what a auditor is going to want to see is some type of contemporaneous mileage log. And we've had a couple audits in this area, and what they took as evidence was a Google Calendar or something is showing your appointment, showing that you were totaling up some miles. Essentially, it's making an effort to show that you're using it for business at the end of the day, and they would maybe take 3 to 4 months worth of your calendar to look at it. So as best as you can, and we understand people aren't going to be perfect with this, but try to keep some type of mileage log. And I mean, there's plenty of apps out there right now that can help you do
Probably
that.
do it automatically, knowing when you get in your car.
Mm-hmm. Yeah. So, but again, I mean, I've had clients that we've taken over where they've said, well, I don't want to deduct anything for automobile expense because I see that as being a red flag for an audit. And a lot of the red flags that you hear about when it comes to auditing, quite frankly, just they don't exist. Again, you're using your vehicle in part for business. You shouldn't be going out and buying a $90,000 SUV and saying, I'm going to write off 100% of that. However, you should be able to capture some of that as a deduction going forward, because most certainly, especially in a small business, you're going to be using that vehicle for business. For some of our other clients in industries where they're buying service trucks and things like that, it's just a very simple, you bought the truck and you are using that usually 100% for business. And it's always been an easy deduction for them.
What do you think in the case where somebody starts their business? Does it matter that it's titled personally?
I think perfect world, if you wanted to appreciate that vehicle, I would retitle it into your corporation. I could see an auditor going, well, really, this is a personal thing. You have it titled in your personal name. Again, I think one of the things people need to keep in mind when it comes to either taking deductions or doing things, the industries that we serve don't get audited all that frequently. I think simply because of how much money you're taking in for the most part. Your largest expense tends to be wages, which is proved out by the W-2s. So there's just not a ton of audits to go into, well, you took $4,000 of vehicle expense and really it should have been $2,800 or whatnot. So that said, if you did happen to get audited, I think it makes sense to have it in your business name versus personal. So I think the next thing we can kind of take a look at, and I think see people not necessarily pick the right thing for their particular situations, going their retirement planning and HSAs.
Okay, so the HSA is the health savings account, and this is available to people that are covered under high deductible health plans, which seems to be the way even the corporate world is going right now. So if you are under a high deductible health plan, you can put in 2021, it's up to $3,600 if you're single per year. And then a family plan would be $7,200 per year. And that's a deduction above AGI. So it's going to reduce your taxable income. And then you can use that money for any qualified medical expenses incurred during the year after the plan's been established. The other way to use that is to save that money and pay your medical out of other out-of-pocket cash. And then that balance is going to grow. It's going to give you a tax deduction every year, and it'll be available for when you're older and when you have extensive medical. So I've heard financial planners suggest that before as another way to defer taxes if you're in a high income situation.
And really HSA is more of, for lack of a better term, tax avoidance versus tax deferral, because if you do use it for its intended purposes, it never really gets taxed. It's not like the 401k where we put the money in and ultimately that money becomes taxable to somebody. It's just deferring or kicking that can down the road. So, I mean, HSA is really more of a deduction.
Right. When it comes out, it's not taxable. So
when it comes to retirement plans, I think one of the things every taxpayer needs to consider is where they are in the continuum of their retirement planning. And oftentimes we'll see doctors in their 50s and 60s doing massive profit sharing contributions when they already have more than enough money in their 401k account. And they have to understand that that money ultimately is going to be taxable in the form of required distributions once they hit 70 years old. And I think people always think, okay, I'm going to be retired, I'm going to be poor, I'm not going to have any money. And in fact, I mean, we see all sorts of retired people who have a higher taxable income than they ever did when they were actually working in the field, because they don't have any deductions at that point. They don't have children. They don't have mortgage interest or some of those things that help to drive down their taxable income. So just because your retirement guy is telling you, and I think with some measure of bias in their they're thinking, because the more money you put in the retirement plan, the more money they get paid, of thinking through what is the best amount to put in. I mean, certainly if you're younger and you have time on your side, getting that tax deferral can be a really powerful thing, because you're not going to pay taxes on anything for 25, 30, 40 years, depending on where you are in that cycle. But we do see a lot of older clients who will still put, the full $25,000 into the 401k. They'll have their spouse on the payroll. They'll do another $25,000. They'll do the safe harbor match on their 401k. And then in addition to that, they'll go ahead and do some measure of profit sharing on top of it when they already have $2 or $3 million in their 401k and could retire tomorrow. So that's probably a mistake.
Because conversely, you could put that in a taxable account, right? And then you'd have capital gains when it comes out.
Exactly.
Which right now is, 15 to 20% versus a 37% top ordinary rate.
And then just in terms of picking what plan works best, I think simple IRA to some extent works really well for a client who is at the start of their business. They're not fully funding maybe plans and things like that. But I think they should always consider doing a 401k versus a simple IRA, because you could have certain years where if you've had some staff turnover, if you've had some changes within it, you could contribute the maximum of $57,000 into that plan. And maybe your employee match isn't as high as the taxes that you're saving. And I think even looking at it further, freeing up that 20% tax deduction, if you can get your income under $315,000, there may be some years in the 401k where it makes complete sense to do a full contribution, even though you're going to match your employees at a relatively high percentage, that the tax savings that you're going to generate by doing that may outweigh that. Whereas a simple IRA, we don't have that level of flexibility with that plan. And I understand a 401k comes with a little bit of cost, a little bit of a compliance headache to it, but the amount of flexibility it gives us as tax planners and you as a taxpayer really, I think, outweighs any of that cost. So the next thing that's getting more and more controversial, especially with the tax law change that came out 2 years ago, is family on payroll. And back in the old days when we were doing tax returns, it was pretty common to see a kid on the payroll at about $6,000, because it used to be the standard deduction was $6,000. So a child could earn $6,000 before having to pay any income tax. So back in the old days, we had all these kids who were quote unquote cleaning the offices. And we had spotless offices back in those days. And unfortunately, those kids got downsized in recent years to become models. And one of the things that has driven this is there were a few publications out there by tax planners, especially within the dental and medical industry, that when the tax law changed to make basically the first $12,000 of income tax-free was to employ your child as a model for your business. And in my mind, the flaw in that logic is a deduction has to be ordinary and necessary. So in the past, were you ordinarily hiring models to be on your website? You probably weren't. You probably put a few pictures up of yourself. Maybe you got some stock photos or things like that when your website was designed, but you weren't going out and hiring Cindy Crawford to be on your website and paying her modeling fees. See, I dated myself by bringing up Cindy Crawford as a model. And so this idea of taking a newborn child and putting them on the payroll for $12,000 simply because they have a couple of pictures on the website, to me, I think you're flirting with an audit as the IRS works through all of these. And in fact, we've even seen Social Security Administration on really young children send letters going, send us a full job description of what this newborn baby is doing to justify a $12,000 salary.
Well, the other thing to consider is the labor laws in your state. Mm-hmm. And the tax law has no minimum age written in, but I mean, your labor laws might be different.
Right. And in Wisconsin, I believe you have to be 12 to have a work permit. And it might be even 14 on that. So, I mean, that's something to keep in mind when you're doing it. I think rather than saying your child is a model within these offices, there's other things they could do, like help you filing, help with cleaning the office, help with, most, especially our dental clients have those promotional bags that they give you every time you go in, they could stuff those things. And I think trying to rely on telling an auditor that my kid is a model when they come in is almost a guarantee to get that deduction overturned.
So you're saying there should be some sort of job description written up.
Mm-hmm.
Probably should have hours written out like you would a normal employee.
Right. And again, I think, it probably makes sense for maybe a child, depending on what age they are, to make somewhere between $5,000 and $8,000 a year. I think walking them right up to $12,000 just seems blatant and would be something that would be overturned on an audit. Again, this is something, making that jump to $12,000 really became popular about 2 years ago. And it usually takes the IRS a few years to catch up with people doing these kind of deductions in mass. I mean, one really good example I can come up with is back in 2001, you could go out and buy the $6,000 pound vehicle and be able to deduct the whole thing right away. So every doctor, dentist in the world was out there driving a Hummer for some reason because he had 100% deduction on it. And the IRS came back a couple of years later and kind of modified the depreciation laws as it came to that. So I wouldn't be surprised if they make some modifications to how you compensate related parties or your children, coming up in the future. They could even use something like the kiddie tax, I would think, to say it's great, you can pay your kid, but they're going to be taxed at your rate if it's coming from a related party. So just something to kind of keep in mind. You can pay your children. It's perfectly legal to do so, but it should be something that is in some range of fair market value for what they're doing in there. It should be noted, if you are a Schedule C or you're an LLC for tax purposes, that deduction is even more lucrative because you don't have to put them on the formal payroll to get the deduction, and you don't have to pay the 15.3% FICA tax. So they just become a line item on your Schedule C of minor children on the payroll for however much they were paid, and they don't have to get a W-2. If you're incorporated or you're part of a partnership, in order for them to be paid, they do have to get a W-2 at the end of the day. The other area where people or family members have always been paid within an office is to put the spouse on the payroll. And the purpose of that always was to double up what one could put in their retirement. So if you are going to put your spouse on the payroll, you should be doubling up your retirement. You should be doing double 401k contributions or something like that, because if you're not, all you are doing is paying a 15.3% FICA tax you don't need to pay. And that has to be the calculation of putting your spouse on the payroll, is saying, are we going to be contributing to our retirement plan? If we are, I think you put your spouse on the payroll. Again, they're going to need some type of job description in order to be on the payroll. And I think that's obviously an easier one to justify because, they probably are doing some stuff like going and getting supplies. They are probably listening to you talk about the business or helping you plan that particular business. So there's definitely a role that is within there, but should be a job description, and they should be contributing to their retirement plan. One of the things, we've seen this mistake made a lot of times, is the spouse is working in a job where they have a 401k, and for whatever reason, the person hires them within the business thinking, well, they can put $19,500 in their 401k over at their regular job, and then we're going to do a $19,500 into this additional job, and you can't do that. The amount they can defer into a 401k is capped at $19,500, whether they do it at their regular job or whether they do it at your job. And I would argue it would be better to do it at the job that they actually have, because that's somebody else is making the match versus you making the match on it. So I think when it comes to putting family on the payroll, it's one of those things I think everybody does. And I think so long as I think you'd agree with this, maybe as long as it's reasonable, it's probably not going to be a problem for anybody.
Especially with the spouses. Like you said, that's been going on forever. What do you think with somebody adding the last payroll of the year? They haven't put their spouse on the payroll all year and now they want to put her on for $25,000.
I think, again, perfect world is you want to pay, whether it's your spouse or your children, that they're on a regular payroll just like everybody else within that. Again, it's an issue that would have to be audited, and you'd have to have an auditor who would look at maybe the timing of those particular payrolls as to, is there really a bona fide need for the person to be in there? So it might be overly cautious to say you can't do the one-time payroll, but again, you're trying to say this is an ordinary and necessary business deduction. So it's one of those where you just don't want to, hey, we had a really good year, so now everybody's going to be on the payroll, and then the next year you're a little bit tighter and you go, okay, I just went in and I fired my whole family because it didn't make as much tax sense to do. So it's something to, again, I think we've seen, in the past couple of years, people wanting to really push the envelope on putting family on the payroll, especially small children. I think in my mind, I always thought, a child should be at least, because I have 4 children, you have 2 children. There's not a whole lot that our kids could do right now that would contribute value to our practice. Maybe our older ones could. I just don't see the 5-year-old coming in and doing much of anything constructive. Maybe your children are gifted.
I got to teach mine to do bookkeeping one of these days.
So if you see one of our kids doing your tax returns, rest assured, we'll review them at the end of it. One of the deductions that kind of ties into vehicle expense a little bit is the establishment of a home office. Couple rules on home office that really need to be followed, especially if you do get audited on it. First thing an auditor is going to ask you is whatever space you're using within your house, is it exclusively for business? And if you answer, well, no, my kids come in and they play on the Nintendo Switch, or I have my Peloton in there, or it's actually part of my kitchen, that's not going to work. It has to be an area of your home that is used exclusively for business. Now, I think practically we understand that when somebody sets up a home office, 100% of their time in there might not necessarily be business related, but that's what the question needs to be answered as, is its exclusive use for it. And I think what they're trying to avoid there is they don't want somebody saying, well, I'm going to take half of my house as a deduction because I could theoretically be doing business. I could be taking a phone call in the kitchen, or I could be taking a phone call in the family room or whatever, and now this is business use of home. So I think that's kind of a natural limitation they've already put on the home office deduction. The second big thing is you have to be able to perform a significant function of your business that you are incapable of performing at your normal office. So let's just think of our dental offices and whatnot. The logical thing for a home office would be, hey, I go there, I pay bills, I review periodicals, I'm doing some things that I just don't have time to do within the context of my day at the office. What they would be looking for if they were to question you on an audit is kind of a duplication of what you're doing. If you're saying, well, I pay all my bills and I do all this stuff and I can do it at both locations, they're going to say you don't really need a home office. You already have an office within your business. So you don't have to do all the same tasks that you do in your business. So if you're a dentist, you don't have to see patients at your home. You don't have to put a dental chair in a room and do, hygiene checks or anything like that. But you do have to do a significant function of the business, which could be bill paying. It could be, you're doing your charting and that's where you choose to do it in your house versus in the dental office. You just want to avoid that duplication of services. So how it gets deducted is you take the percentage of your home that's allocated toward the home office, and you have what are called both direct and indirect costs. So what a direct cost would be is anything that you did that enhanced that particular space. So for example, if you had that space painted, You had some ductwork put into it in order to make it a room that you could use year round. You had to replace a window in that particular room. That would all be what's called the direct cost, and would be 100% reimbursable for your business. The second thing is indirect costs, and those are all the costs that the household incurs that doesn't really care whether or not you have a home office or not. So things like your property taxes, your mortgage interest, your utilities, your insurance, repairs and maintenance for the whole house would be considered in that. That's where you're going to take that percentage of what your home office is, and you're going to take that multiplied by the amount of those expenses to determine how much could be reimbursed. It should be noted, though, when you take that, and let's say you allocate some of your mortgage interest and real estate taxes or whatnot to your home office, and you take a deduction there, you can't double dip and use both portions as an itemized deduction, which
actually might be a good thing right now.
Which actually is a good thing, because most clients don't necessarily itemize their deductions anymore. So if you're going to deduct that home office, just make sure it's exclusive use. You can justify that you're performing a function that you couldn't otherwise do at your normal office, and you should be fine there. I think where it also becomes helpful is when we're talking about vehicle expenses. I remember when I was in college, our accounting or our tax professor said to us, talking about the virtue of home office, was it creates a second commute. So he always joked, and he would say, I get up in the morning, I walk down the hall, and I go to my first office. And then I hop into my Corvette after that, which I think said something like Taxman on it or something like that for his license plate. And now every mile I go is tax deductible. He is in fact right. So if you have a home office, instead of writing off maybe 45, 50, 60% of your vehicle, it's going to allow a much higher write-off for that vehicle. It's not going to get you to 100% necessarily, because you're still going to have some element of personal use for that vehicle. However, that standard does apply. That's a physical location of your business. Your first commute was you walked down the hall in your bathrobe, you walked into that office, and now you walked out the door. So you've created that second commute on it. So I think home office is a legitimate deduction. It just has to be used correctly. You can't use your whole house for it. I would say probably on average, if we look at the square footage of home office, probably somewhere between 8 and 10% of the home or so.
So I have a couple of things to add to that. There was 2 cases that just recently came out with home office. And so it doesn't necessarily even need to be a distinct room. In one of the cases, the taxpayer lived in a 422 square foot apartment, and he was able to isolate a small amount of that for his business, which worked out to be 23%, and the IRS allowed that deduction. So it wasn't even a distinct room. And then the other case was a taxpayer living in a 9,000 square foot home, and he claimed 90% was used for business, which did get knocked down. But they reviewed it and they decided that 13 rooms were actual business. So he did get to deduct a substantial amount of his home for business use. So it's kind of interesting.
13 rooms.
Probably doesn't apply to our clients, but. And then the other point I just wanted to bring up too is the home office deduction used to be available if you were an employee as well, up to a couple of years ago as an unreimbursed business expense. So that went away a couple of years ago, but I'm sure people right now, I know they are. Everyone's working from home. They're trying to figure out what are they going to get out of it. And right now, if you're an employee, this deduction is not available to you.
Correct. And I would say, I mean, when it comes to some of these deductions that we're talking about, with like home office or what we're going to talk about next with like the Augusta rule of any particular year where it just seems like a more safe or a better deduction, this is probably the year where people are actually physically establishing home offices for their businesses, much more so than certainly you would have a client say, well, I do have a home office, even though to some extent you knew they didn't. People are establishing home offices or making modifications to their homes to accommodate work there. And then the home office kind of ties into what's always been referred to as the Augusta rule or the vacation exclusion for a home. And basically there's a quirk in the IRS code that allows you to rent your house out for no more than 14 days and not have to pay any income tax on it, not have to go through all the figuring out depreciation, all the expenses and all the reporting that would come to it. It's called the Augusta rule because people would rent their houses so people could go to the Masters tournament, and people would rent their home for that week, and they didn't want to create all this tax compliance that would be associated with something like that. The loophole that tax planners have brought up with the Augusta rule is, in theory, you can rent out your home for up to 14 days and have your business pay rent to you and take a tax deduction, and then you wouldn't have income tax on it. A couple things to keep in mind on that. First is you have to be using your home. There has to be some need for your home to be used for your business, that you would rent it out to the business. So I think things like maybe an office party, I think things like maybe staff meetings, if you were to do it there, if you were to have a small office and that it made sense, I think you could go ahead and do so. The second thing I think to keep in mind is whatever that rental rate is, it should be some measure of reasonable. And what I mean by that is you could go to a hotel and rent out space and get a conference room and all those things. How much does it cost in your area? Is it $400 or $500 a day? Is it $750 a day? You can't necessarily go out and say, well, I'm going to rent my house out for $10,000 a day and do it for 13 days and create $130,000 of rent. It has to be reasonable in terms of that rental rate. And you also have to have a business purpose in order to do it. You can't just necessarily say, well, yeah, I rent out my house 12 days. IRS would probably ask for some documentation of why did you do it? Why was it ordinary and necessary for your business to do it? So again, I think there are some tax planners out there, when you read some publications, who are relying on the fact that there's not very many audits out there. And again, our job is as CPAs and as the people who have to sign the returns, tell you, okay, if you do get audited, here's what you need to have in place in order for this to be a legitimate deduction. But it is a legitimate deduction if you're able to use it properly. I don't think that's the case for most of our clients to be able to use it in that fashion. Finally, just to wrap up on one of the deductions that's getting a lot of attention, especially within our healthcare sectors, is the use of a research and development credit. And tax credits are great because the big benefit of a tax credit is it reduces your income tax dollar per dollar. A tax deduction is merely lowers your taxable income, and then you apply a tax rate, and that determines your savings. So credits are really powerful tools. And there's a few firms who are out there that specialize in these credits that feel as though dentists and orthodontists and places like that should be able to utilize this particular deduction. To give you some context on it, the research and development credit is written in such a way that's, for lack of a better term, it's pretty vague. And it talks about, are you using some new process or some new procedure or some new methodology to complete a task? And how they're trying to shoehorn this within dental is to say, well, every tooth is almost a snowflake, and you could approach it a completely different way. So a root canal you might do on Megan might be totally different than the root canal you do on Mike. That's taking, I think, a very liberal interpretation of what research and development happens to be. And in fact, one of the firms that is really pushing this is kind of the first to admit in a podcast I heard them on that, well, if this does get audited, we're not totally sure this passes muster. So the reason the research and development credit hasn't gotten much attention in the past was it's always been there, but it was always subject to the alternative minimum tax. And when the tax law changed 2 years ago, that alternative minimum tax isn't eliminated, but for all intents and purposes, it is. I mean, we used to have probably 75% of our clients who paid some measure of alternative minimum tax, whereas now, I don't think I had any last year. Do you have any that were AMT?
No, haven't seen it in a couple of years.
So this credit that used to be out there, there wasn't really worth doing because for 75 or maybe even higher of a percentage of that, the alternative minimum tax would simply take it away. Well, that's not the case anymore. And because it wasn't a credit that was widely used because of that, usually how the IRS passes a law is it's a very vague law to start with. And then from there, they kind of introduce regulations and things like that to kind of say, well, here's what we really meant by this law. So I don't know if you agree with me, but I think as the IRS starts looking at these R&D credits, especially as it relates to doctors, dentists, or things like that, I just have to think they're going to put in more restrictions and more verbiage into the law, because I don't think their intent is that if I'm a chef out there and I go, hey, I'm making an omelet, what would happen if I put scallions in it? Would it make it more delicious?
It would.
I mean, it probably would. And is that research and development? If I do a tax return and I say, usually I always enter the W-2 first, but I'm going to try something different right now. I'm going to enter in all your deductions first. Is that research and development? If I bring in my 11-year-old child to give it a crack the first time and say, would that be better for our business if we allowed him to do the return? I mean, by the really broad definition, I think it meets the standard, but I think that whole substance over form argument or ordinary and necessary just doesn't, I don't think it holds a whole lot of water. But I guess what I would say is if you are going to pursue that credit, there are firms out there who specialize in this particular area that will put together all the documentation that you would need to claim the credit. It's not unlike what we would do with the cost segregation study, where if somebody really wanted to claim this, we would refer them out to a firm to provide kind of the study or all the research and all the documentation that would be needed to claim the credit.
Well, from what I remember, because I've worked with these on manufacturing companies, it's a fair amount of documentation, like interviewing employees. What do you do and how do you track the time associated with that? Because it's based on wages and kind of over a rolling couple of years. So
it's something that's out there. It's something that's getting more and more press, especially if you're reading things like White Coat Investor or the McGill newsletter, things like that. It's something to consider. I think if you are going to do it, just make sure you get it documented appropriately, because even if it gets overturned, if you can show that you made a good faith effort to take the deduction and comply with the law, it's unlikely they would hit you with the 25% penalty for underreporting. But
you alluded to this too. Losing a $20,000 credit hurts more than losing a $20,000 deduction.
Absolutely. So it's something that should be considered. However, I would tread lightly on it. Again, I don't know how much research and development is really going into every procedure that you're doing. And again, I mean, if you really follow out the logic of what they're saying, every tax return we do is different. So ergo, should we be able to subject all of our wages and whatnot to research and development? Because there are different ways you could do a tax return. You could do a monthly financial statement or things like that. So the big thing, and we're reaching out to clients right now as we start hitting November to kind of do a second tax projection to them. These are all the kinds of topics we're going to be going over with you and kind of seeing what fits best for your situation. We have clients all over the board who are very conservative in terms of what they'd like to take for a deduction, because they feel that anything could be a red flag, to those way over on the other side who really want to push things and go into the proverbial gray area. But I think these are some of the major items that are out there that if you can document them properly, if you can demonstrate that it's an ordinary and necessary business expense for you, you should be able to get deductions for them. However, if it's not ordinary and necessary, if it's not passing muster and stuff like that, if you did get audited, these are some things that could be overturned.
Well, and what I've always heard too with auditors, they're going to look at the things that they understand or seem as sort of an unfairness. So like meals and entertainment was always one that was looked at, because why should your lunch be deductible and mine's not, is sort of the mindset. And these are going to just pop out as things they understand and as employees can't do themselves.
Right. I mean, auditors at the end of the day are people, and people have feelings. And again, I think on any audit that we've ever been through, and mostly they're done at the state level, tends to be, if 95% of your stuff looks really good in terms of you're following everything, you might get the benefit of the doubt on a deduction that might be considered to be controversial, and maybe you don't have the best documentation for it. But I recall we had a sales tax audit several years ago, and it was a tax return that was prepared before we took it over, but our client had essentially bought himself a $30,000 watch as a gift for being in business for, 25 or 30 years. And
You're not allowed to do that, Mike?
Yeah, as you can imagine, the auditor kind of looked at that, and then every other deduction that was completely legitimate was now viewed through the prism of, well, what about that watch? And it just made everything hard on that particular audit to get anything through. Like, for example, they did a year-end party for their staff, and I think it was at a place in the Dells, and they were disallowing that for the longest time, saying, well, even though it's a completely legitimate expense, did it have to be that extravagant? Did it have to rise to that particular level? So big picture, I think tax planning or things like that is, you have to remember you are in a service industry at the end of the day. If you are making a lot of money, unfortunately, at some point, you're going to pay a lot of taxes, and there's not a magic bullet that can be fired. But I think if we're able to do several little things correctly, from your choice of entity to making sure you have a vehicle that's being deducted in some measure, I think to wisely using some of the other deductions that we talked about, maybe we're knocking $15,000, $20,000, $25,000 off a tax return every year. And as you go out 10, 20 years, that money really starts to add up. So that's what we have for this week on the Cornerman. Next week, we'll be bringing on Dave Dorley to talk about life and disability insurance. And we'll see you next time.
Thank you for listening to The Cornerman. Be sure to leave us a review and subscribe to us wherever podcasts are found. For more insights and information, visit us at bullmoosefinancial.com.